There's still a couple of people trickling in, but let's get started. And welcome to our first ever BlueMark Insights Hour. I'm super thrilled to have you all here and have you all taken the time to join us today in this new format that we hope will be an ongoing event series of BlueMarks. Before we start, I just quickly want to introduce myself. My name is Ben Kramer. I'm the BD Director, Business Development Director here at BlueMark. I'm based in Boston and originally from Germany. As you all know, for the first Insights Hour, we've chosen the topic of impact reporting, and there's a couple of reasons why we did this. First of all, we all know that right now we're knee deep in the reporting season. So reporting is front and center in a lot of our minds, and it's a work that we're currently actively pursuing. And we also know that it's very complex to do impact reporting, especially when we do it properly. And it takes a lot of time, it takes a lot of effort. And at the same time, we have a lot of evolving best practices that are happening. And we hope that the Insights Hour today will help you shape some of your impact reporting and help you with that process. The overall idea around the Insights Hour is a kind of ask me anything style of event. So we hope that this serves as an open, interactive space where you can ask questions. And I deeply encourage you to actually ask questions during the time today. And our hope is that you gain some insights from our team here and walk away at the end of the day with some takeaways to improve your own impact processes and for your impact reporting that's going on at the moment. We will kick off today with some questions that have been pre-submitted to us by some folks prior to the Insights Hour, and then we will be taking questions that are coming in live and triage those and try to the best of our ability to answer as many questions as possible today. At this point, I want to shift your focus to the bar on the bottom of your Zoom. There's a Q&A section. So if you can click that, or if you click that when you have questions, type in your questions, we'll see them, and then we can take those on to answer them. And at the same time, if you have trouble hearing us or for any other reasons, there's also a captures feature down there where you can read what we're saying. It's a pretty cool feature Zoom has. And this does real-time capture of or captions, which is great. Before kicking us off and before starting, I just want to give a brief introduction to BlueMark for the folks that are unaware of what BlueMark is and what we do. BlueMark is the leading provider of impact intelligence services and independent verifications for the sustainability and impact market. What that means is we work with a whole bunch of different allocators and investors and firms across different industries, to assess and verify their impact management practices, their reporting standards, and the credentials of impact and sustainability funds. And at this point, as you see, I'm not alone up here. I would love to introduce you to my wonderful colleagues, Mya Stanislas and Timothy Lambert. Mya, why don't you kick us off with a quick intro and then hand over to Tim, and then we'll dive right into questions.
Yeah, thank you, Ben. Hi, everyone. My name is Mya Stanislas, and I'm an associate on the BlueMark team. I'm based in Philadelphia, and I work on the client services side of things. That means I'm doing our verifications of impact investors, impact management practices, and also their impact reporting processes. So that means I've gotten to evaluate a number of impact reports, and I also am participating in the impact performance reporting norms pilot by Impact Frontiers on behalf of BlueMark. And yeah, I'm really excited to be answering some of your questions today. Tim?
Thanks, Maya. Hi, everyone. Pleasure meeting you. My name is Tim. I'm based in Belgium. Also a proud dad of a baby who's celebrating his first birthday today. And I'm also BlueMark's Europe manager, which means I'm essentially supporting our clients on the European continent and helping BlueMark increase its footprint over here. So yeah, happy to delve into the conversation.
Perfect. Well, thank you very much, and happy birthday to your baby, Tim. At this point, start with the first question, Tim. Don't we start with you? And one of the questions that was submitted was, why should we even do impact or report impact performance, and who cares about reading these results? Can you tell us a little bit about that?
Sure. Yeah, I think it's a great question to start this discussion. Essentially, like from engaging with many clients and impact investors in the markets, often hear that there's a tendency to think that reporting can be a very costly endeavor, that it can be also a source of reputational risks. What if we communicate about negative impact to the markets? Also, sometimes GPs may complain that LPs do not really actually read their impact reports. And so there's many reasons to kind of discard it from the onset. But I would say there's at least three, good reasons to take impact reporting seriously as an impact GP. The first one being that an impact report is essentially an opportunity to pause and reflect upon lessons learned. So it's an opportunity to look back on past performance and derive learnings that will chart the path forward. It's really an opportunity to discuss improvements to your investment strategy, to your impact management approach, etc. Secondly, it's a great tool to hold yourself accountable for your claims, for your actions, for your results, and so really, going beyond using reports as a publicity stunt or a marketing tool towards using it as a tool to show responsibility and accountability towards your key stakeholders. And last but not least, it's a tool that should be designed with an eye on supporting better decision making. Essentially, impact asset owners and allocators. So those are the LPs that inform their investment decisions based on the impacts of your fund on stakeholders and the planet. They use impact reports as a primary source of information during their due diligence to figure out whether your impact thesis, your impact management approach and results align with their investment thesis. So overall, like very good reasons to work on impact reports seriously. And also based on our verifications and engagement through the market, we're seeing a growing appetite in the market for robust fund level impact reporting across the globe.
Perfect. Well, thank you very much, Tim. And Maya, the next question is for you. How often do managers provide impact reports to their LPs? And then I'll make it a double question. Are managers typically creating these reports just for their LPs, and are they doing different reports for public-facing purposes? What's your insights on that?
Yeah, great question. I would say managers are typically providing impact reports at least annually, sometimes quarterly. When it is quarterly reports, those are primarily for LPs, and they have more of a focus on investment level, financial and impact performance data, usually combined. While public-facing reports usually are serving, a broader audience or set of stakeholders. Public-facing reports tend to incorporate more narrative and storytelling into the fund or the strategy's, overall impact goals or theory of change. Whereas we've seen quarterly reports are a bit more streamlined and quantitative. We do see investors creating reports that are different, but often the quarterly reports are feeding into the data from those are feeding into the overall annual reports that are more public-facing.
Perfect. Well, thank you very much for this. Now there's actually questions trickling in through the chat, so thank you very much to our attendees for that. One question I see here is, how does BlueMark see LPs typically using impact reports alongside other impact-related disclosures like SFDR 9? Maya, do you want to take that one?
Yeah, sure. I would say it's kind of difficult to give a definitive answer given the current context and different ongoing regulatory changes, excuse me. But I would say SFDR reporting generally aligns with some of the voluntary norms we're seeing. And I saw a question in the chat around some of the best-in-class GP reporting and other standards that LPs are focused on. And I would say SFDR reporting generally aligns with the impact performance reporting norms by Impact Frontiers, which is one of those standards when it comes to disclosing fund-level impact objectives, your management approach, as well as reporting on a set of negative risks. So the principal adverse indicators that SFDR requires. However, what we've seen is most allocators expect GP level reporting that goes beyond just regulatory requirements. It also sort of depends on how managers are structuring their reporting. So some are clearly differentiating between regulatory disclosures, focusing more on compliance, and then some impact reports are focused more on providing insights into the impact results. So say that's the key difference. And some of the standards like SFDR, ECDI, PRI, they're all more compliance focused, which can help LPs collect that standardized data and metrics and benchmark or monitor risks, but they're really not enough to interpret, impact performance in and of itself. So I'd say like quality impact reports, and I think a theme throughout this will be that they're intended to fill the gaps and provide, additional contextual information that supports understanding of outcomes and impact performance to the ultimate readers of reports.
Perfect. Thanks. Really appreciate it. And going, you've mentioned in your previous answer to a question, public-facing reports. So if we go back to those, what are key features that make up a high-quality impact report, whether it's public-facing or even internal-facing or like to LPs only? And how can you make them feel? I mean, we all know the misconception of things feeling a little bit marketing-y. So how can we make them feel like a marketing report, but also not?
Yeah. I would say overall, I think the most important thing in a quality impact report is one that is contextualizing impact performance and reports a complete view of a manager's impact strategy and results and is not reporting data in a vacuum so that it can be understood. I think the first feature of a high quality impact report is clearly defining the impact objectives. So articulating what the strategy aims to achieve. I think people often think of data and metrics when they think about impact reporting, but without a really clear understanding of what the fund's aiming to achieve, that data can be meaningless. It can be hard to understand. For example, like is X number of tons of emissions avoided really a good outcome if you're focusing on affordable housing or reducing inequality? So I think that's why the specificity of intentions or goals is really a crucial first step in any impact report. Secondly, I think how the manager contributes to the achievement of impact. So writing down the portfolio level, overall value add strategy or contribution strategy. I think that was one of the questions in the chat that we've gotten. That's really important. Differentiating between being an impact investor and non-impact investor and how you're going above and beyond, whether that's providing new capital or engaging or stewardship, but the ways in which you're adding value overall as an investor. It's also really important to note the impact risks that are associated with your investment strategy. Any of the unintended consequences that could come up from your impact strategy. We'd also always want to see some investment level reporting. So like a description of the portfolio company or the investment or the asset. We want to see KPIs. I think one of the really important things is context. So if you're reporting an impact KPI, we want to see, the baseline value, what it was, the time of investment or year-over-year data. So you can really understand the drivers of performance and the trends. And lastly, I think a description of the impact management approach and the processes behind your strategy. So the ways in which you're assessing investments for impact, the way you're monitoring impact, collecting data is really important so that it's clear that there's something behind the data that you're reporting. So I would say those are the sort of key pieces, but just want to reiterate that I think the impact strategy and a complete and reliable view of the results as well.
Perfect. Thank you very much for that, Mya. And I, in your response, you just mentioned investment level reporting, and I think that's a question for Tim. And it's actually a question I often interfere when having initial conversations with some of our clients and potential clients. So I snuck that one in here. If LPs, they often want to see impact performance at the investment level, so at the very detailed granular level. And what level of detail should I, as a GP, provide on individual investments? That's something I often hear in the market.
Yeah, thanks for this question, Ben. I think so. As Mya mentioned, there's definitely like a growing consensus for sound investment level impact reporting. So instead of cherry picking a couple of portfolio company data points to share, I'd rather really covering the portfolio impact performance in full detail. And actually, we're seeing in our verifications of impact reports that it is still not a common practice within the industry. Actually, only 35% of impact GPs reports on portfolio company impact performance. So there's room for improvements, and the impact performance reporting norms have done a great job, I think, at determining what kind of information fund managers can include to provide relevant and contextualized impact data for each portfolio company. Maya mentioned a couple of examples. I would add that, alongside impact results relative to past performance and to targets and baselines, it's also worth disclosing your investors' intention when investing, your investor contribution, like what is the additionality of your investment to that company, and how do you keep track of your additionality over time. I definitely recommend to read the impact performance reporting norms for a full list of data points to consider. What I just want to say here is that there's no expectation for fund managers to disclose all data points from the onset for two reasons. One is that if reportings are designed to be decision-making tools, like tools that support LPs and GPs in forming their decisions, we should disclose we should disclose enough to inform those decisions. So we should not be very comprehensive or cover all the points ever. And also, as proposed by the impact performance reporting norms, there's a principle of comply or explain that GPs can adopt when preparing their reports, whereby it's okay not to report everything as long as you provide a good rationale or a good reason for not reporting a data point. And I think that definitely fosters transparency and credibility in your reporting when you also consciously and clearly articulate your decisions. So, yeah, I hope this answers your question, Ben.
Yeah, no, I really appreciate it, Tim. Thank you very much. And in the point of data from underlying portfolio companies, Maya, I think the next one is a good question for you. We hear that aggregating data from these portfolio companies, from the investees, is not always an easy task. So how can GPs disclose this reality in a way that makes it more reliable?
Yeah, this is definitely a question we hear a lot. And I think, aggregation of investee level performance data, it's not a requirement for sound impact reporting. If it's done poorly, it can generate sort of vanity metrics and make reporting seem kind of superficial. Many impact LPs we work with voice their preference for investment level reporting because it does make room to report metrics that are specific and relevant for each company. So I think it's really important that you're not compromising sort of meaningful insights or significant nuances between different investment level metrics. I think if it makes sense, if a strategy is organized around themes or verticals where the metrics are easily aggregatable to those, I think that makes sense. And that could be appropriate, but otherwise, I think focusing on impact KPIs at the investment level makes sense. I would say in general, metrics should be tracked back to a good theory of change. So like as a general rule of thumb, if you have a really specific sector theme, theory of change, or a specific strategy you're focusing on, like circular economy by investing in XYZ, then it probably makes sense to aggregate at that level. Mm-hmm. But I would say the reason the market, and I think the norms also push investment level reporting, is that it's always possible to do a detailed theory of change at the company level. So focusing on, the challenge the company is addressing, the sort of solution that's being offered, and the core outputs that can be tracked from that. So in general, you'd always want it to be tracked back to that. And there are other ways to express portfolio performance. I mean, we've seen they're not always performance-based, but what we've seen is like mapping the percentage of capital that's been allocated to different themes, different geographies, to the SDGs. If a manager uses some kind of internal scoring or rating tool for investments, we've seen like average scores across the portfolio reported. And then other normalized, there's like impact weighted counting methodologies, impact per dollar. So there are other ways to do it. But overall, it's tricky. And I think overall, if there's not an easy way to do it, then you can stick with the investment level reporting.
Perfect. Well, thank you very much for that. And another question that just came in through the chat. How often do we see at Bluemark that managers include external benchmarks and thresholds to contextualize their impact performance at the portfolio or investment level? And the person here gives the example of Iris Plus benchmarks and nature-based targets. Maya, do you
Yeah.
want to respond to that?
Yeah, definitely. Target setting is, I mean, it can be really difficult. And another question that's related is sort of best practices regarding setting or changing impact targets over time. I think, to report a metric against a target, you first have to have the practice of setting targets, whether that's with your investees or internally, so that you're able to report on them over time. And for portfolio level, we see some targets established for capital allocation or impact performance. So sometimes we see a number of greenhouse gas emissions avoided that a manager wants to reach. We see patients served, affordable housing strategy. We could see amount of capital going into a certain percentage of low-income communities. So where metrics are easily aggregated, reporting at the portfolio level against external benchmarks can be useful, like Iris Plus or other science-based targets. Internal benchmarks, like I said, like values at the time of investment, those can also be used as a reference point. Ideally, you would have investment level targets that can be set. This isn't always feasible, really depends on the asset class, the amount of influence the investor has. So if neither benchmarks or targets exist, performance can be assessed against baseline values that at the time of investment. We also see sometimes for VC clients where the founders and the companies are just getting started. So sometimes we see targets first linked to revenue or the percentage of revenue linked to their impactful product or service, and then that kind of being projected over time. But I would say it's a bit more of an art than a science right now. And I think the overall goal is to ensure that impact data is like meaningfully framed and demonstrates progress and effectiveness, and can also be shown over time where you have that data. And I would say less than 50% of BlueMark verified clients set investment targets. Yeah.
Perfect. Well, thank you very much for that. And then the next question I see here coming in from the chat, I think Tim, that's one for you, as it takes the talking point of yours from your first answer around positive and negative impacts and how to show them. So the question is, how do I report a balanced view of impact performance that includes both positive and negative impacts? And then how do I make this information useful to LPs?
Well, that speaks to one of the biggest complexes I feel that are still existing in the impact investment industry. There's a data point that I believe Impact Frontiers also like refers in its webinars, where they show a research by Jane that shows that only 1% of impact investors claim to have underperformed on impact, whilst that same group, 15% admit to have underperformed from a financial perspective. Now, does that mean that only 1% really underperform, or does that mean that there's still people, the market is still feels uneasy about communicating negative impacts in its reporting? I think the latter is true, and I think that there's also good reasons why GPs feel maybe some tension and are scared to disclose impact underperformance or even negative outcomes within their reports. One is because not everyone is doing it, so why should I do it if my competitors don't disclose negative impacts? How is that going to influence the LP's view of my performance? But yeah, I think in essence, what we're seeing in the market is that different regulatory standards and voluntary standards are driving increased accountability for negative impacts, and are making the practitioners increasingly comfortable with disclosing this type of information, making it a common shared practice across the industry. In terms of how concretely to the point of how to ensure you present a balanced view, without going into all the details, I would give two concrete tips. One would be involve your stakeholders in reviewing your impact reports, which basically means present the data to them, present your narrative to them, and ask for feedback. And your stakeholders can be obviously investors, but they can also be your investees. They can be the end beneficiaries, just depending on the context. But really provide them an opportunity to give feedback on your reporting. That will definitely contribute to creating a balanced reporting review. And the second tip would be, in case you can't access or involve your stakeholders, maybe try adopting John Rawls' veil of ignorance. Like, just look at your data as pretending that you're ignorant about your personal circumstances and interest, and just ponder whether what you're reporting on seems like it's a faithful and fair representation of reality, whether it indeed covers the full spectrum of material impacts your funds has been creating. So yeah.
Perfect. Well, thank you very much for that, Tim. So going back to the chat, there are some questions around reliability and accuracy of data. So we have a question around self-reported data from portfolio companies, and that has limitations. And how can fund managers do anything to enhance the reliability and accuracy of this information? Maya, maybe you can speak to that.
Yeah. I mean, this is something that comes up a lot too, and it's sort of dependent on the underlying practice for data collection and data management. So if it's self-reported data from portfolio companies, I guess what the fund manager can do and the tools they have at their disposal is, one, having a really clear internal review protocol to ensure, consistent and accurate data collection. Within the report itself, being transparent about the data sources, any assumptions. So if you're collecting the same impact metric from different portfolio companies and they might calculate a different way, making sure that's clear within the report. What we often see is like a page or half a page within an impact report that has sort of assumptions, methodologies, limitations about data.
Mm-hmm.
That could be like in an initial report and then just live on a website and be linked externally in the future. It doesn't have to change too much. But I think it can be tricky. And I would say, yeah, having that internal review mechanism and then just disclosing where the limitations are is the most that can be done. We see third-party assurance of data points. It's rare, but an option for usually like the top line KPIs of a impact report or for a strategy. We see that, but it's difficult. And I would say other ways to ensure integrity. There's different tools that can be used for inputting data, like Novata is one of them. And then especially another question on aggregating data from multiple fund investments as opposed to direct investments. That's for fund of funds pretty difficult, and it can be hard to, compare apples to oranges. So that's where like investment level, or if it's a fund of fund strategy, fund level reporting comes in to help account for those nuances. And where you want to share really rigorous impact data, where they're like, especially for carbon emissions, there can be really complex calculation methodologies underneath them. I would say to make that, accessible and understandable is having that section on the calculation methodology and trying to write it in a way in more layman terms so people can understand it. And if they want to go look at a more detailed view, that can be linked on a website or externally. That's what we commonly see.
Perfect. Thanks, Maya. And relatedly, we just got a question in earlier about it's an LP with a portfolio that spans multiple asset classes and impact themes. And they're wondering if you can recommend existing tools that can help them streamline and consolidate their impact reporting. And I know you've just talked about a couple of tools, but maybe you can shed some more light on that.
Yeah, I would say it can be difficult across asset classes. Sometimes we see separate reports, but I think to the extent that the different asset classes you're investing in link back to a similar theory of change, you can have one portfolio level theory of change that can hopefully cover and make clear the different levers you have for the different asset classes. So the overall challenges you're trying to address, the solutions and what you're investing in different asset classes that are contributing to addressing that challenge, and then the different outputs you're collecting for the different asset classes. So I think you can put that all into one theory of change. And then when it comes to aggregating, if you have different themes, again, hopefully the themes link back to a theory of change, or we see instead of an overall portfolio or fund level theory of change, we sometimes see at the theme level you can report. If it ends up like the reports getting really long, those can always like live on a website or somewhere else and they can be linked out. But I think it's really important to have that context there to have theme level theories of change. In terms of aggregating, it's probably very difficult to do. And I would say if it's a large portfolio with multiple asset classes, you can do case studies like Tim was talking about. So choose one or two investments that you think are representative of the asset class or the theme. Hopefully spanning not just exceptional impact performance, but also maybe where you weren't reaching targets or where performance stayed the same. It's a really important aspect. And then, doing it that way so that you can show a representative sample of your overall strategy across asset classes and themes.
Perfect. Thank you very much. And I have actually two questions, one for you, Maya, and one for Tim. But maybe we'll start with you, Maya, and then hand over to Tim around attribution and additionality. So for you, how do I report on investor contribution efforts without claiming attribution?
Yeah, this is one we definitely hear a lot. And I think it first starts with the practice of investor contribution. So first defining as a fund manager what your contribution is going to be to the investments that you make, whether it's financial additionality, provision of new capital, or at better terms, or non-financial, so engagement, signaling that impact matters. So I think once that's defined and you have a standardized process for assessing your own investor contribution for each investment, that's when you can start reporting on it. You can report on it at the portfolio level. So as part of a portfolio level theory of change, we sometimes see that's where the manager would write, and this is how we're contributing to achieving these outcomes. So you can put it there, you could put it in a separate value add or contribution section. But in terms of the actual contribution efforts without claiming attribution, I would say rather than claiming sole responsibility for the results, which is really hard and why investors don't want to do that, I would say really clearly outline the actions that you've taken, whether you have any engagement outcomes, if your additionality strategy is more based on financials, any like follow-on capital, post-investment to demonstrate catalytic impact. It can be done through case studies. So you could have like one case study about a company you engaged with and some real change happened, or as part of the overall theory of change. But I would say it first starts with the practice of having a clear process for tracking your investor contribution, and then you're able to report on it in a more streamlined way, and then choosing a few case studies to highlight that.
Perfect. Thanks. That's helpful. And Tim, for you, question from a GP: what is the typical additionality process for GPs, and what is best in class that we see?
Great. So what is a typical additionality process for a GP? So in essence, the impact of an impact investor is the extent to which their financing and their non-financial support contributes to changes in the end beneficiaries' outcomes, like changes in their well-being or changes in the well-being of the planet or the environment. And so there are different levers that impact investors can mobilize to optimize or increase their additionality. There are non-financial levers, as mentioned. So it's about engaging with your portfolio companies in ways that are conducive of increased impact. It can be, for instance, like supporting them with stakeholder engagement and strong impact accounting or measurements. So establishing the right processes and tools to capture stakeholder views, integrate the data within core decision-making processes within your investee companies, and making sure that the impact is really closely monitored. That would be like a concrete example, but there's like many different ways a GP can contribute non-financially to the success of its investees and its impact. From a financial perspective, there are basically two key ways an investor can deliver an additionality. One is by investing in overlooked capital markets that are known to contribute to some sustainability challenges. So really about like driving capital to where it's lacking, basically. So anywhere there's like a missing middle challenge or like a lack of financing, you can be additional. Also, it's also about considering the extent to which your financing instruments and your financing terms are tailored to the reality or the needs of the investees. So there also consideration for you know, the amount of risk you're taking on you versus giving allocating to the investee, the expectation of like the financial return expectation you have, and kind of the patience, your overall patience, like as to when you expect to exit the investee and recuperate the capital invested. So yeah, these are the different ways an investor can be additional. And I guess a best in class impact investor would probably combine different ingredients. And so be active non-financially by supporting investees whilst providing additional capital in ways that are either catering to undersupplied capital markets or providing tailored financing.
Perfect. Thanks for that, Tim. And switching gears a little bit, there's a couple of questions coming in here that are diving in again on the metrics and that detailed level of reporting. So maybe, Tim, this one's for you. What are common quantitative and qualitative metrics that are used to communicate impact?
So yeah, I mean, to find metrics, there's different places, databases, taxonomies one can refer to. You know, there the iWish Plus could be a good example. The Jin has published a database of impact metrics and open public source of impact metrics. But there's a couple. I mean, we're happy to share some references afterwards. But I think the essence is to ensure that the metrics you're choosing are actually relates to material impacts and outcomes that you're trying to measure. So instead of jumping right away to metrics and KPIs to measure, I think the starting point should be to clarify what we're trying to measure. Like, is that a material change? Is that a change that matters to the stakeholders that are being affected? And you know, how then should we go about collecting data that allows us to monitor performance? And that's where the KPI question comes up. But so yeah, KPIs can be found in both regulatory standards like the taxonomy, the EU taxonomy, or in voluntary standards like IRIS Plus, IPSO, HIPSO. Like there's different sources where an investor can find relevant metrics to consider.
Perfect. Thanks, Tim, for that. And then Mya, maybe for you, the next one that's more about assumptions. So what do you think about assumptions, academic or otherwise, that are going into the impact data? What's the standards? What is needed? What is expected?
Yeah, that's a great question. I would say there's not one standard. I don't think there's a standard for it out there yet. I think whatever you feel the reader of the report would need, like the context or underlying information the reader would need to fully understand the performance and understand the metric, is what's important. So whether that's like a paragraph or a full page, or you're linking out to, if it's a really complex assessment methodology, linking out to that. But I think, yeah, there's not a clear standard for right now. And whatever you feel is most appropriate for the reader to fully understand. And I think the impact performance reporting norms has a section on this. And I think it'd be great to reference that, and it has some great tips and examples as well.
Great, perfect. I think we have time for one more question. So I'm going to close it out with Mya. Maybe if you start, Tim, if you have something, you're obviously welcome to jump in as well. What is something that you're not seeing in impact reporting or in impact reports that you think is important to include?
Yeah, that's a really great question. I think we are not often seeing a lot of the narrative on like lessons learned. So based on how the strategy's been going so far, the impact performance results, whether at the investment level or the overall portfolio, sort of reflections on how that's been going, drivers behind that performance. And then any changes that you'll be making to the strategy or, to your investment strategy based off those lessons is something we're not often seeing, which I think is really important to include. I think the overall context behind performance, whether it's staying the same, I think that's an insight in itself, whether it's declining or whether it's improving. Thinking about the drivers behind that performance and then how that informs your strategy going forward. I also think some of the lessons learned and any improvements to actual impact management processes are helpful to see. I think impact management is really an evolving thing, and it's nice to see managers that they're on a journey of this, and that there's more to learn and that they can improve their processes over time.
Perfect. Thanks, Maya. And yeah, due to time, I still see questions trickling in. So thank you very much for the lively participation here of our attendees. But due to time, I think we'll need to wrap it up here. At this point, I think I wouldn't do my job properly if I wouldn't give you a quick overview of the reporting verification that we offer at BlueMark here. The reporting verifications that we do is we evaluate the alignment of your impact reporting plans, your impact reporting approach, or published reports to best practices and market standards. And how we do that is that by leveraging our own impact reporting research that we've done in the past, as well as the impact performance reporting norms that were published last year. And if you are interested to continue this conversation, please feel free to reach out to me directly. I can also triage questions to Tim and Maya at ben.kramer@bluemark.co. That's Kramer with a K. And likewise, as I just mentioned, if you have any questions regarding that we weren't able to answer in this Insights or first Insights hour, you can shoot me an email, ben.kramer@bluemark.co. And I am happy to triage that to Timothy and Maya or respond to them myself, depending on how detailed your question will be. At this point, I just really want to say thank you very much to everyone dialing in today, taking the time today to participate in our first Insights Hour. As we mentioned in the very beginning, we want to make this an ongoing series of events that we hope to do on a regular basis. If you have any feedback or suggestions, you can, and now I promise you that's the last time I'm going to give you my email address. You can contact me at ben.kramer@bluemark.co. And I'm really looking forward to receiving questions, suggestions, etc. And yeah, I think that's it from our end. Thank you very much for dialing in, and I'll see you next time.
Thanks, everyone.
Thanks. Bye-bye.
Everyone, bye-bye.